Hello traders, this is the weekly market update podcast from the Peepwise Broker. We start from the economics, and in the United States, we heard mostly positive news and reports from the United States last week. Industrial production rose double the amount the market expected in the manufacturing output, which makes up 78% of the total production, advanced 0.4% compared with market forecast of a 0.2% increase. Taking into account the better than expected Philadelphia Fed Manufacturing Index, which rose to the highest level in 3 months, it seems that the American industrial sector is slowly crawling out of the contraction trajectory. Capacity utilization in the US rose to a 9-month high of 78.8% in June, from a downwardly revised 78.3% in May, and above market forecasts of 78.4%. Even though the rate is now almost a whole percentage point below its long-run average, but this still won't help the dovish FOMC members to push for an earlier and sharper decrease in interest rates, as a rising capacity utilization rate is usually inflationary. Building permits in the United States rose by 3.4%, which is the highest in 3 months and above market expectations. Also, housing starts in the US rose by 3% from the previous months, and rebounding from a revised 4.6% decline in the previous months, and firmly above market expectations. And this is why the average contract interest rate for the 30-year fixed rate mortgage declined to 6.87% in the week ended July 12th. This is the biggest decline in borrowing costs in about 4 months and the lowest rate since the second week of March. This combination bodes well for the ongoing recovery in the US housing sector and is positive for the American economy as a whole, but at the same time prevents Fed from cutting too early. Another good report was the retail sale, which was particularly positive. While the general retail sales were flat, sales excluding food services, auto dealers, building material stores, and gasoline stations, which are used to calculate GDP, were up by a whopping 0.9%, the largest increase since April 2023. These reports validate the IMF recommendation that in the countries like US, where upside risks to inflation have materialized, central banks should refrain from easing too early on interest rates. Also, we should take note that the gold prices suffered a heavy blow last week, falling almost 800 pips from the top as the good US data came out. The only negative report out of the US was the unemployment claims, which rose by 10,000 to 243,000 on the period ending July the 13th, reaching a new weekly high and surpassing market expectations of 230,000. The 4-week moving average for initial claims, which reduces week-to-week volatility, rose by 1,000 to 234,750. Still, when we combine these reports, the picture that we get from the US economy is a robust but cooling economy, which implies that the Federal Reserve will have difficulties in decreasing the rates too early and too sharply. Elsewhere in the world, we got the ECB rate decision, which on Thursday chose to keep the interest rate unchanged at 4.25%, according to the estimates and expectations of the market. The important point was that Christine Lagarde declined to pre-commit to a September rate cut, which is positive for the euro. And when we combine the weak data coming out of the UK, we can speculate that the euro-pound rate in the coming days will shoot higher and will retrace a good part of its recent decline. In the United Kingdom, we had 2 important reports, one about the job market and another about inflation. In the job market, unemployment rate stood at 4.4% from March to May 2024, unchanged from the previous 3 months period. It remained at its highest reading since the 3 months to September 2021. Meanwhile, the number of employed individuals rose by 19,000. Most of the jobs created were in part-time employees and full-time self-employed workers, while full-time employees and part-time self-employed workers decreased during the last 3 months period. And this subtracts from the rather positive headline number as falling full-time hiring is an ominous sign for the job market. Average weekly earning, including bonuses in the UK, increased 5.7% year on year, but we should note that this is below the 5.9% in each of the previous two periods. The picture that we can get from the UK job market is that it is cooling and the wages are beginning to decrease, and this bodes well for the BOE or Bank of England to start cutting rates soon. About the inflation in the UK, annual inflation rate was steady at 2% in June 2024, the same as in May and holding at 2021 lows. The annual core inflation in the United Kingdom stood at 3.5% in June, holding steady for the second straight month while staying at its lowest level since October 2021. Figures were in line with market estimates, but we should note that the CPI services annual rate came at 5.7% for the second consecutive month. On a monthly basis, core consumer prices increased by just 0.2%, the least in 5 months after a 0.5% rise in May. Another report which is also important, but not as important as the job market reports and inflation report, is the retail sale. Retail sales in the UK declined 1.2% month over month in June, which was worse than the market forecast of just a 0.4% fall. The picture that we can get from the UK economy as a whole is that we have decreasing levels of price pressures and increasing level of recession pressures, which I think will force the BOE to increase the amount and the acceleration of the rate decreases during the next coming weeks and months. In New Zealand, we had also the inflation report, which indicated that in this country, the annual CPI rate slowed to 3.3% in the second quarter of 2024 from the 4% in the March quarter. It came slightly below market expectations of 3.5%, marking the lowest reading since June quarter of 2021. This data should push the RBNZ or Reserve Bank of New Zealand to begin its cutting cycle aggressively and early, and this will put downward pressure on the New Zealand dollar in the FX market. In Japan, the annual inflation rate stood at 2.8%, holding steady for the second straight month while remaining at its highest level since February. The core consumer price index in this country, which excludes fresh food but includes fuel costs, increased by 2.6% year on year, accelerating for the second straight month and rising to a 3-month high, following a 2.5% gain in May. Japan's core inflation rate has now stood at or above 2% for over 2 years, and this will push BOJ to continue its hiking cycle from July or from September. In the geopolitics arena, the Houthi militias attacked Israeli capital of Tel Aviv on Friday, with an Iranian-made drone, which killed 1 and injured at least 3 others. In response, the Israeli Air Force bombed several targets in Al Hodeidah port in western Yemen, which caused widespread fire and cut the electricity. There are reports of some killed and injured among the civilians, and the Yemeni army spokesperson has promised to harsh retaliation. This is a major escalation and will definitely affect the global markets when reopened on Monday, most probably pushing up the gold and oil prices while putting downward pressure on equity and crypto markets. And the next week, we'll have PMI reports for the US, Eurozone, and the UK all over the week. We'll have the BOC Bank of Canada rate decision on Wednesday. We'll have the US GDP report on the Thursday, and the most important data that will be published next week will definitely be the US PC report, which will be published on Friday. Take care and have a good trading week.